Yeah, all good, Connor. Thank you very much.
How are you?
Very good. Can't complain. How about yourself?
Good stuff. I'm always good, thank you.
Always good. That sounds good to me. Fantastic. Well, all right. Well, I'll kick off if that's okay with you then, Connor, and I'll start off with performance. That's what most advisors are kind of clued in on. So here's an updated table up to the end of Friday, 25th of September. And I've put on the Acumen portfolios 3 through 8 and the income portfolio. And on the right-hand side, there's performance for the rolling quarter. And then on the far right-hand side, beyond that, for the last rolling 6 months. So, very positive news. Over the last 3 months, the majority of the portfolios are ranked in the first quartile, with the Acumen portfolio 3 in the second quartile and the income in the third. And if you look at the position ranking relative to the IA sector, many of the funds are still in the top 10. So the Acumen portfolios 4, 5, and 6 are ranked, 7, 6, and 5 respectively within their sectors. So super thrilled with performance. Not only have we predominantly beaten the IA sector, but we've also beaten the traditional market composite benchmark that we also have in place. And as I've alluded to before, the most important thing really is that we beat the peer group. The benchmark is I view it as more of an internal bar that is very high, and if we beat that, then we're going a long way towards beating the IA sector. And if we stretch it out over the last 6 months, the story is pretty much the same. We're predominantly ranked in the first or second quartiles across the range. The one exception is the income portfolio. This is a dividend-paying strategy, and of course, many companies, due to the coronavirus, have had to suspend or cut or make adjustments to the dividend payments they make. So as a broad strategy, it's done less well than the rest of the proposition. But in terms of comparing it to the IA mixed 20 to 60, it's not necessarily a particularly fair comparison because that IA sector doesn't specifically target a yield or a dividend. So not particularly ideal. Increasingly and purely on an internal basis, what I might suggest for anyone who has money invested in the income portfolio is you look at the IA UK equity and bond sector. It's not a perfect comparison because it's predominantly focused in the UK, whereas we're more global in nature, but it is the most similar, the most relevant IA sector, purely because it's multi-asset class and it targets a dividend. And actually, we continue to do very well against that since inception. So the question really is, what is behind this good performance at the moment? What are the main reasons for it? So I'm just going to address a few of those in turn. Now, many of these themes we kind of laid out in our most recent quarterly perspectives, which actually went out about a quarter ago. We need to think about writing the next one, which should be released in the middle of October. But effectively, the narrative is the same. So one of the key themes as a team we're looking at is ESG. We have the ESG protection portfolio, but that doesn't mean we can't invest in ETFs that provide access to ESG, environmental, social, and corporate governance factors, across the rest of the proposition. James is the ESG portfolio manager. He's doing a fantastic job in this regard. And one of the key investment positions we have in the portfolios is in the iShares Global Clean Energy ETF. It's a substantive size within the portfolios. It's not small. And this chart effectively shows the performance of that ETF since the beginning of the year in white. And as you can see, the performance has returned over 40%. And if we compare that to the standard MSCI World, which is a generic index to represent global equities, that is more or less flat over this time frame. And actually, if you invested in a traditional energy sector within the MSCI World, then you would have lost about 40% of your money. And that's basically because energy prices have been particularly hard hit as a result of the coronavirus. So key theme number one for you and for your clients and prospective clients, ESG continues to do well, and we think it's going to continue to do well into the future, given strong structural tailwinds from not only governments who are increasingly spending a lot more money in this space as part of their fiscal spending plans, but also millennials, and on a gender basis, we find that female investors over male investors are much more inclined to put money into this area, and it's only going to continue to grow over the long run. So really pleased with that performance. Moving on to the next slide. Theme number 2 is the US dollar. So we sorry, I was letting the cat out the door. The US dollar. So we've been calling for a weaker US dollar relative to other currencies for some time, and as we know, the US dollar has fallen in value considerably over the last few months. Now, we put out multiple blogs on this theme. What I've done on this slide is just make reference to a speech for the history books where we reiterated our call for a weaker dollar over the medium term. And on that chart on the bottom right corner is the chart we included in that blog. If you should be able to see it, the white line effectively is the year-on-year change in the dollar. And as you can see, it's fallen quite considerably over a period of time. Now, not only are we benefiting from this from an FX perspective over the last 3 months, given the movement in the value of sterling, but we've also benefited from this in our asset allocation. So the white line and the red line move together, which means effectively that when the dollar is falling, the US equity index underperforms the rest of the world, and that's effectively what we've seen. So we also have an underweight allocation to US equities relative to the rest of the world, and US equities have indeed underperformed other regions over the more near term. And that's kind of reflected in the chart on the left, which effectively says over history, the value of US equities as a share of global equities is now up around 60%. Now, the last time we were at these levels was around the dot-com bubble. So unless we're going to really move beyond this point, and our view is that we won't, then there's a good chance that the share of US equities within global equities will continue to fall, and we are positioned for that over the medium term. So that's theme number 2. Theme number 3 is emerging markets. So when I say, if the dollar falls, it benefits the rest of the world, that's true, but in particular, it will benefit emerging markets. Now, on that same blog I mentioned previously that came out on the 1st of September, we put out another chart which effectively showed the movement in the US dollar index. Once again, the white line is exactly the same as the prior slide, but the red line in this instance is looking at emerging market currencies. And once again, you see that the white line and the red line move in tandem. But the story this time around has been dollar weakness relative to developed market currencies, predominantly the euro, which makes up the vast majority of the dollar index on a trade-weighted basis. However, it's not the same for emerging markets. Emerging markets have not yet, as an aggregate whole, benefited from this dollar weakness story, and that's the red line. And the gap between the red line and the white line, which is highlighted by that yellow arrow, at the moment is around 15%. So we think there's considerable scope for emerging market currencies and emerging market equities and bonds to catch up over time. And we are positioned for this by being overweight emerging market equities. But we're doing it in a nuanced way. We're not just going generically overweight emerging market equities because that would be a relatively risky thing to do. So instead, what we've decided to do is be a bit granular in terms of our allocations. Now, this slide basically highlights that, and it says over the last 3 months, let's look at emerging market countries, and let's just very simplistically categorize them into those with a strong current account balance sheet as a percentage of GDP, and that's everything on the right-hand side of the central axis. And anything with a weak current account balance sheet as a percentage of GDP is on the left-hand side of that central axis. Now, what's really interesting is of all the blue dots on here that represent emerging market countries, all but one of those countries with strong balance sheets have seen their currencies appreciate in value relative to the dollar. Those countries with a weak current account balance sheet, some of them have appreciated, but actually if you look at Brazil or Turkey, that have also been particularly hard hit by the coronavirus, their currencies have fallen in value, and by quite some margin. Indonesia is another example where, despite having multiple islands and therefore perhaps a geographic advantage to control the spread of the virus, because you have a natural barrier, it's called the sea, their handling of it has been absolutely appalling. And therefore, the confluence of those factors have also seen its currency fall in value. So what does this slide mean? What we're saying is we like EM, but we have a bias for quality. So as a result of that, we are predominantly exposed to China, both in equities and in bonds. We also have large satellite positions in South Korean equities and Taiwanese equities. So this has benefited the portfolio because we've had a tailwind from the currency over and above the strong performance of the equity market as well. Moving away from equities and just turning our attention to bonds, I sent out an email on Monday. That's going to get turned into a blog and hopefully will be in your inbox by the end of the week. The theme of that blog is Chinese government bonds, and I was very fortunate to be contacted by ETF Stream, which are one of the premium publications in the ETF space. If you don't regularly check their website, I thoroughly recommend you do so. So they've been running a number of events, and the one last week was on smart beta, and the one prior to that was on emerging markets. So I was able to join that with other participants from AJ Bell and JP Morgan. But the key theme here really was this dollar weakness story is good for emerging market local currency debt. But within emerging market local currency debt, there's a real strong case to be made for Chinese government bonds. Last week, the FTSE Russell, which is owned by the London Stock Exchange, announced that it will be including Chinese government bonds in its benchmark, the World Government Bond Index. Now, there's around $2.5 trillion that follow that index, so its inclusion shouldn't be taken lightly. And the most recent estimates from Goldman Sachs suggest that $140 billion can flow into Chinese government bonds, over the 12-month phase-in period. To put that in context, there's around $400 billion invested in Chinese government bonds at the moment in total by what we would call foreigners. So non-domestic, outside China, predominantly institutional investors. So we are capitalizing from this theme. We think there's a tidal wave of money flowing into Chinese government bonds. The rationale for that is you get a much better yield, right? You get a yield of around 3.5% if you're investing in 10-year Chinese government bonds. If you're looking at the equivalent in the US, you get 2.5% less. And what's interesting is the debt to GDP ratio in China is far lower than it is in the majority of developed market countries, particularly heavily indebted European markets as well. So a lot of money that's invested in US treasuries, European government bonds, Japanese notes will flow over time into Chinese government bonds. There may be a little bit of volatility in the interim in the run up to the election, but this is a longer term structural trend. We have a large position in Chinese government bonds. Andrew, the fixed income manager, kind of made the recommendation that we increase our allocation to this space in general earlier in the month, which we have done. And our exposure is now approximately 12% of our fixed income bucket. And this chart shows that over the last 2 months, actually predominantly since the 1st of September, this position has outperformed a broader basket of emerging market local currency government bonds by 7%. So really happy with that, particularly strong performance, and a real great story to tell your clients and your prospective clients as well. Theme number 4, inflation expectations. Now, we put out a large number of blogs on this, effectively saying that the immediate impact of the coronavirus was deflationary, or rather disinflationary. But over time, given the sheer amount of money that's been pumped into the economy, the supply bottlenecks that are emerging within precious metals, but also within the agricultural areas of the economy as well, would likely lead to a medium-term pickup in inflation. Now, the role of markets is to be forward-looking in nature. So even though we're not necessarily seeing a surge in inflation, it is picking up, the markets will be pricing that into a far greater degree. And that is reflected in this slide by the red line, which shows the 10-year US break-even rate, which effectively means inflation expectations. What are the expectations of inflation over the future? And it's been picking up ever since the start of the crisis in February, March. We have benefited from that in the portfolios via our allocation to a TIPS ETF, Treasury Inflation Protected Security, and that has done particularly well relative to the benchmark. So that's a key theme. It's also been rather buttressed as a longer term theme by Jerome Powell coming out and saying we're moving to an average inflation targeting regime. So in the past, if inflation was getting up towards 2%, they would start to raise interest rates. And they did that on the basis that they felt they would need to choke off inflation before it kind of captured hold in the economy. And what Jerome Powell is saying, this is a fundamental change from what Volcker did in the 1980s. We are now far less worried about inflation. In fact, we're more worried about disinflation, and we're more worried about going down the route that Japan's gone down, where their economy has done nothing but just deteriorate, since its heyday in the 1990s. They're terrified of that, and they want to do everything in their power to ensure that inflation and inflation expectations stays positive. So they said we're going to allow inflation to run hot over 2% for some time to ensure that inflation averages at 2% over the medium run. Now, the upshot of this is effectively that real yields have been falling, and that's the white line here at the bottom. So real yields are the interest rate accounting for inflation. Now, real yields are correlated to a number of things. The dollar weakening, well, yeah, that's what we're seeing. That's a key theme. Things like tech outperforming, because tech is basically like a long-term bond, right? It does well when interest rates are really low, and that's going to be the theme for some time. And also it's correlated to commodities, which I think leads us really nicely onto the next slide and theme number 5, which is the commodity carve-out. So real yields are correlated to a weaker dollar, which is correlated to stronger commodities. Now, this is one of my favorite charts of all time, super geeky. And what it shows is, number one, commodities move in cycles. So kind of look at that red line. The red line represents the S&P Goldman Sachs Commodity Index. And you can see it kind of was at the bottom around 2000, 2001, peak of the dot-com bubble. It rose significantly in value and then dropped back down to 2008, 2009. Rose in value, dropped back down 2015, 2016, Euro growth slowdown. Rose in value, dropped back down 2019, 2020. So commodities move in cycles. We know that. That's just a common trait within commodities. But more than saying generically every few years it will go up and down in value, what we did was we looked at the ratio of gold to oil. And what we found is the first circle you can see in this ratio between gold and oil effectively says peak optimism. Everything's great and it's going to last forever. And then something changes. And what you see is you see gold outperforming oil because there's a concern that things are slowing down, and maybe we need to find some safety. And then it rises to that second circle. Now that second circle is the peak outperformance of gold versus oil. I want you to think of that as peak pessimism. Things can't get any worse. And that's usually the best point to get into like cyclical parts of the economy. And actually historically it's been the best time to get into commodities. And you can see that that's kind of where we were. So at that second circle in orange on the right hand side of the chart, we opened up a commodity carve out across the portfolios that was scaled from 2% in AP3 all the way up to around 12%, but we've gone as high as 15% in AP8. And it's performed exceptionally well over the last few months. The gold price has had risen to all-time highs at around over $2,000 an ounce. It's come back since then, but it's still been a huge ride. Silver, the devil's metal, extremely volatile, and typically has been very, very cheap relative to gold. It's done pretty much nothing for the last few decades until it broke out of this technical pattern here. And we identified that as a team, and we felt silver can not only outperform gold, but actually it can do very well in a scenario where the economy slowly starts to pick up, because 50% of silver has practical use in the economy in terms of electronic circuitry, etc., etc. So we opened an exposure to silver, and performance has gone through the roof. At one point, it rose 50%. Recently, silver has come off the boil, and actually, just to provide some color to that, Connor, could you just quickly go back 2 slides, please, if that's okay? This is it perfectly. Now, recently, inflation expectations in red have started to come down, right? And that means that at the bottom here, real yields in white at the bottom of the chart have started to rise. Now, when I said real yields are correlated to commodities, you know, I'm absolutely right when I say that, because if you, Connor, if you could please just move back to that slide we were on before on silver, that rise in real yields is part of the reason why gold has come off recently, and it's part of the reason why that drawdown in silver has taken place. But we're still up 20–30%, so we're still doing really well at the time being. Internally, Jonah, portfolio manager, we're having internal discussions about what we do with this position over time. Do we hold on to it because we think it's got further to go? I think it does over the medium to long run, but you know, or do we think about taking profit in the near term? So those are the kind of conversations as a team we have all day, every day. And this is a chart on copper. So moving on from precious metals, we also have exposure to copper in the portfolio. It's a base metal, gives us a bit more exposure to a cyclical pickup in the economy. So whereas we're predominantly exposed to quality, we're a bit more defensive in nature in some areas, this is part of the portfolio that's pointing towards, if things pick up and we get a V-shaped recovery, how do we benefit from that? Well, this is one of the positions that will benefit from that theme. And without going into too much detail, we like copper because of this term structure within commodities. So it's in backwardation, which effectively means that the spot price is higher than the forward price. And when that happens, it's typically correlated with copper doing very well. And the price of copper is in blue here. So, you know, it's a bit uncertain at the moment, but we're going to continue to hold this for the time being because it gives us that exposure in the portfolio that we so desperately want to balance it out. Okay, and then so all of those are the key themes in terms of the positions we're taking in equities, bonds, and commodities that are the driving force behind recent strong performance. Relative to our peer group, the IA sector, another key theme is currency. Now, you know, many of you are aware because we've discussed this previously in terms of our strategic review, but, you know, we have been kind of at a different starting point relative to many of our competition in the IA sector from a currency perspective. So historically, we have always predominantly hedged the majority of the portfolio back into UK pounds because that's the base currency for the majority of our clients. However, that isn't the case amongst other funds in the IA sector. So as a result of the strategic review, one of the outcomes is to become more dynamic in how we manage our currency exposure. So as you can see here, this is the 5-year chart for sterling dollar. And as you can see, it's operated within this channel for the last 5 years, which means those white lines there are key levels. If you're buttressing up against the top line, the majority of market participants think that sterling is probably too expensive relative to fundamentals, and therefore it will fall in value. And conversely, when the line hits the horizontal white line at the bottom, the majority of market participants think, it's the other way around. Sterling dollar is arguably cheaper than underlying fundamentals suggest they should be, and it serves as a support, and as a result of that, the currency typically rises in value. Now, we have benefited from a degree of optimism over the summer months where sterling dollar rose all the way up to just shy of 135. So that's buttressed our performance. Since then, sterling dollar has fallen off. We decided to give it the benefit of the doubt to see if it could find support on that top white line where previously it was acting as resistance. We failed to find support, and as a result of that, as a team internally, we had some discussions, we did the work, we did the analysis, and we decided it would make sense to reduce the size of our dollar hedge and open up a dollar exposure. This is a more granular chart to kind of show you what's been happening over the last 3 months. So sterling dollar rising in value throughout June, July, moving in a horizontal range throughout the first half of August, breaking out of that range in real optimism that maybe something can be done on Brexit, but then falling back into the channel. Then it tried to get back into the channel again, but it failed once, twice, and actually 3 or 4 times. And that tells me, all right, we really need a proper breakthrough on Brexit for sterling dollar to really get back to the highs it was at before. The odds are now that maybe we will see shorter term sterling weakness, particularly in the run up to the presidential election. And actually in the 50 days preceding the last 7 presidential elections, the dollar's typically rallied in value relative to developed market currencies by 3%. And also seasonally, this is typically a weak period for sterling as well. So we have taken action. We've been, we said we would, and we have. And as it currently stands, we've opened up around a quarter of our US dollar developed market equity exposure. So we could do more if we wanted to. One of the key things we're looking at the moment is that yellow band at the bottom of the chart. So what you can see is historically in July, the sterling dollars interacted with this band once, twice, 3, 4, 5, 6 times. So it's a key important level. And actually on the right hand side of the chart, you can see we've kind of bounced off of it a couple of times as well. If we fall through that level, that's the next catalyst for us as a team to decide whether or not we want to open up more dollar exposure. So, I think the price action in sterling dollar would have hurt us relative to our peer group in September, but we have minimized the impact, whereas previously we may not have taken any action at all. But more importantly, we've kind of locked in some of those currency gains over the last 3 months, and that's why the numbers continue to look good. So that's the currency. And then what I'm going to do now is, actually, what I might do, Connor, is just pause slightly before just giving a very brief update on, where we are in the bigger picture, just to see if anyone has any questions on those first few slides.
Yeah, no, that's fine. If anyone has any questions, please pop them in the chat and we'll get them put forward to John. John, there's not been any at the moment yet.
Okay, no stress. People have the opportunity to ask those questions, and then we'll answer them at the end. So just to move on to more of a generic market chat, because the first few slides were very specific to our portfolios and they provide you with a strong narrative. This is more kind of what we're thinking as a team, big picture. So many of you may recognize this chart. I love this chart. This is kind of putting everything in context. So it shows you in white the value of the Bloomberg World Exchange market capitalization. So think of that as the total value of the global stock market in white, and the red line is the total value of the global economy in red. This is when the white line crosses the red line, it's an indication that maybe valuations have become too expensive. And this is something that a lot of people look at, right? Warren Buffett is famous for referring to this on a number of occasions. It's kind of one of those key long-term trend charts. Now, every time the white line has historically crossed the red line, it has preceded a fall in global stock market valuations. And actually, what's interesting is, and this chart is an update from the same chart I used about a month ago, the white line has now fallen and is now below the red line. Now, the real question mark is whether or not that white line continues to fall. One reason why it may not is because the amount of stimulus, both monetary and fiscal, has been utterly unprecedented. And that's represented here by the blue line, which shows the size of the US Fed balance sheet. So look at prior occasions where there's a yellow circle. The blue line doesn't do anything. It flatlines in 2007, and it's not till late 2008 where it really picks up. 2017, 2018, nothing happens. But look at that preemptive huge surge in the blue line. So this time maybe it is different. And if we move on to the next slide says if we think the key driving force behind equity valuations is not the underlying fundamentals at the moment, it is liquidity and it is money being pumped. If that's the key theme, then maybe we do have further to go. So on this slide is, instead of looking at the global market, and this looks at the US, and it's the same story. So the white line is the total value of the US equity market, S&P 500, relative to US GDP. Same thing, we're kind of around all-time highs, so it's expensive. But the red line is the value of the US equity market relative to the money supply, and we know that the Fed is printing huge amounts of money, right? But relative to history, the value of the US equity market relative to the money supply is still quite low. So arguably, it potentially has much further to go. If the Fed prints more money, valuations can continue to rise. That's the key theme from that chart. Now the Fed is all over this. At the Fed's last meeting, it said basically, we no longer think of quantitative easing as a remedial action to provide support. We look at quantitative easing as a mechanism through which we can loosen financial conditions to support the economy and to support markets. That's basically the key message from the Fed at the moment. And a lot of people, part of the reason why markets have been selling off recently is because people are disappointed from the Fed. They felt that maybe they were going to announce more at the last meeting, which is kind of unfair because it's the first meeting before the presidential election. So normally it's politically neutral. But actually it's doubly unfair because if you look at the next slide, what you'll see is they're aiming to get inflation back above 2%, and they're aiming to get employment back to 4%, right? So if you can move to the next slide, please, Con. The only times historically that's been the case since 1960 are the bars that are highlighted in yellow. So it's a rare occurrence. It's a difficult feat to achieve. And yet the markets, for some reason, have been disappointed by what the Fed's doing. So I kind of find that very interesting. So maybe the Fed needs to do more, and at the moment, at this juncture in time, the market is also waiting for this new fiscal stimulus, right, from Capitol Hill in the US, right? They need to do something, because if they don't, then we may well see a period of volatility and risk aversion in the run up to the election. And this chart shows you exactly that. So financial conditions. Look at financial conditions in white. They're very correlated to the performance of equities. And what we've seen on the right-hand side of the chart is the S&P 500 really got ahead of itself. It's continued to break all-time highs, continue to rise, even as financial conditions kind of just went sideways and, if anything, fell. So if the Fed wants to keep the show on the road and markets to continue to rise and the economy to rebound, and it definitely does, then they need to do something about US financial conditions. And the key thing is, unless they can take interest rates negative, but they really don't want to do that, right? They can try and manipulate the long end of the curve, right? That's called yield curve control. They've ruled that out for now, but they may well bring it in. So the key driver to really keep the show on the road is to weaken the US dollar, because the US dollar is one of the main components of financial conditions. And that's why we have the view that we do, because it's almost like the Fed kind of has to do it. And as the global reserve currency, the Fed can outprint and outstimulate the majority, if not all, other central banks across the globe. And that's also why we like China, because China is actually not doing any of those things. It's kind of saying, well, we don't need to. We don't need to print as much money as you because we've been more resilient to the crisis. We don't need to provide as much fiscal support as you do, in theory, because we're more resilient to the virus. And that will support the currency, which is why we like emerging market currencies, but particularly China. And it's kind of like why we like that as a general asset class. So what I'll do is I'll just finish off with the next 3 slides. I'll move through those relatively swiftly, and then we can move on to questions. This slide effectively says at some point in the future we're likely to see a rotation, right, from quality names towards more cyclical names, or from large, towards small caps, for example, or from tech to financials. This chart kind of puts that in perspective. This shows the performance of Russell 1000, which is US equities, but growth stocks relative to value stocks. And what we're doing is we're seeing growth stocks massively outperform value because growth is rare, right? It's hard to come by, so therefore it's higher valued. At some point, we're likely to see a similar thing happen to 1999-2000, where value starts to outperform growth because the economic recovery kicks in. The key point is we're not there yet, and until we are, we're going to monitor this. And until we are, we're unlikely to really rotate the portfolios in any meaningful manner. Another way of looking at this is the Nasdaq whale, right? So tech stocks have been massively outperforming the MSCI World, but look at that breakdown. We preempted that breakdown. I'm very proud of the team, particularly Circa's the equity portfolio manager. As a team, we came together and Circa said, tech valuations are pretty frothy right now. We think maybe it makes sense to take profit. Now, it turns out maybe we were a month or two early, but we called that spot on. So now tech valuations have dropped out of this channel, but we're watching it closely because it may be an attractive entry point potentially to get back in again. And then finally, moving on from this tech theme, this is this is a trade idea from Alex, right? Who isn't our equity guy, he's our FX guy, and he's our head trader. But the point is, tech is, as you can see on the prior slide, kind of struggling a little bit, right? But look at this. This shows you that whilst tech stocks have been going through a period of turmoil, gaming, esports, all those teenagers or whoever who are playing computer games and earning an absolute fortune doing it, as a theme, it's another major trend that we like. We like ESG, it's a major trend. We like Chinese government bonds, it's a major trend. Esports is at the beginning of this wave. So it's hardly capitalized. A lot of money is flowing into it. It's already bigger than the film industry and music industry combined. But look at this. Every time the tech sells off, and that's the white line falling, and I've highlighted that in yellow, you can see that gaming outperforms tech, and that's the blue line. So when tech underperforms, gaming is very resilient. But look at those periods where we're not in the yellow bands. Well, the blue line goes up then too anyway. So it outperforms. It does very well when conditions are good, and it's going to do well when conditions are bad. So that's another large position we have in the portfolios that's done really well and has been driving performance.